Look, I'm going to be direct with you because what's happening right now in the global monetary system is something most people won't understand until it's too late. We're not talking about a correction. We're not talking about a bear market. We're talking about the systematic unraveling of the fiat currency experiment that began over 50 years ago. And if you're holding cash, if you're sitting in bonds, if you think your savings account is safe, you need to pay very close attention to what I'm about to show you. The signs are everywhere. Central banks are moving gold at a pace we haven't seen in generations. The BRICS nations are openly discussing alternatives to the dollar. Debt levels have reached mathematical impossibility. And yet, most people are walking around completely oblivious to the fact that the ground beneath their feet is crumbling. Let me paint you a picture of what's really happening. Right now, as I'm speaking to you, central banks around the world have been net buyers of gold for 15 consecutive quarters. Not months, quarters. That's nearly 4 years of relentless accumulation. The People's Bank of China alone has been adding to its reserves month after month, and those are just the official numbers. Most analysts believe the actual accumulation is far higher because China has a history of underreporting its gold holdings until after the fact. Why would they do this? Why would central banks, the very institutions that print fiat currency, be dumping that currency to buy gold? Because they know something. They see the end game, and they're positioning themselves for what comes next. Think about this for a moment. When you and I want to protect our wealth, we might buy some gold coins or open a precious metals IRA. But when entire nations want to protect their wealth, when the people who literally control the printing presses decide they need insurance, what do they buy? They buy thousands of tons of physical gold. They repatriate their gold from foreign vaults. They build new storage facilities. This isn't speculation. This is documented fact. Turkey increased its gold reserves by over 300 tons in a single year. Poland brought back 100 tons of gold from the Bank of England. India has been steadily building its position. Even countries you wouldn't expect, smaller nations that traditionally held minimal gold, are suddenly entering the market as buyers. And here's what makes this absolutely critical. They're not buying paper gold. They're not buying ETFs or futures contracts. They're buying physical metal and taking delivery. They want it in their vaults, under their control, where no counterparty risk exists. Now let's talk about what's driving this behavior, because it's not just paranoia, it's mathematics. The United States national debt just crossed $36 trillion. Let that number sink in for a moment. 36 trillion. That's trillion with a T. The interest payments alone on that debt now exceed what we spend on defense. We're paying over $1 trillion a year just in interest, and that number is accelerating as older, low-interest debt rolls over into higher rates. But here's where it gets really interesting. That debt isn't being bought by foreign nations anymore like it used to be. China has been a net seller of U.S. treasuries for years now. Japan, traditionally our largest foreign creditor, has been reducing its holdings. So who's buying all this debt? The Federal Reserve. They're creating currency out of thin air and using it to buy government bonds. It's the definition of monetizing debt. It's the exact playbook that has destroyed every fiat currency in history, from the Roman denarius to the Weimar Republic to Zimbabwe to Venezuela. And before you think, well, that could never happen here, we're America, let me remind you of something. The dollar has already lost 99% of its purchasing power since the Federal Reserve was created. A dollar in 1913 could buy what takes about $30 to buy today. That's not inflation. That's currency destruction in slow motion, but the pace is accelerating. Look at what's happened just in the last few years. We printed more money during the pandemic response than in the entire previous decade. Trillions of dollars conjured into existence with a few keystrokes. And now we're seeing the consequences. Grocery prices that have doubled. Housing costs that have made home ownership impossible for an entire generation. Energy prices that fluctuate wildly but trend consistently higher. The official inflation numbers say 3%, 4%. But anyone who actually buys food, pays rent, or fills up a gas tank knows those numbers are fiction. Real inflation, the kind you experience in your daily life, is running far higher. And this is where gold and silver become not just investments but survival tools. Throughout human history, spanning thousands of years and hundreds of civilizations, gold and silver have maintained their purchasing power. An ounce of gold in ancient Rome could buy a fine toga and sandals. Today, an ounce of gold can buy a quality suit and shoes. The purchasing power remained constant. What changed was the currency used to measure it. This is the fundamental truth that most people miss. Gold doesn't go up in value. Currencies go down in value relative to gold. Gold is the constant. Fiat currency is the variable. And right now, that variable is moving in a very dangerous direction. Let me show you something that should terrify anyone holding significant cash positions. The M2 money supply, which measures the total amount of currency and near currency in circulation, has exploded. We've added trillions to the money supply in just a few years. Basic economics tells us that when you increase the supply of something, its value decreases. This isn't controversial. This is supply and demand. But here's what makes gold and silver different. You can't print gold. You can't create silver with a computer keystroke. These metals have to be pulled out of the ground through expensive, time-consuming mining operations. Global gold production is essentially flat. We mine roughly the same amount each year, around 3,000 tons. Meanwhile, currency production is exponential. What happens when you have exponentially increasing currency chasing a relatively fixed supply of hard assets? The price of those hard assets explodes. We've seen this movie before. In the 1970s, when Nixon closed the gold window and ended the last vestige of gold backing for the dollar, gold went from $35 an ounce to over $800 in less than a decade. That's not a 20-fold increase because gold became more valuable. It's because the dollar became 20 times less valuable. And we're setting up for a similar move right now, except this time the magnitude could be far greater because the distortions in the system are far more extreme. Think about the derivative markets. The notional value of derivatives globally is estimated at over $1 quadrillion. That's 1,000 trillion. These are complex financial instruments, many of them tied to interest rates and currencies, and they're all built on the assumption that the current system remains stable. What happens when that assumption breaks? We got a small preview in 2008 when the mortgage derivative market collapsed. The entire global financial system nearly imploded. Central banks had to step in with unprecedented bailouts and money printing. And that was just one corner of the derivative market. Now imagine a crisis that questions the fundamental value of the currency itself. Imagine a scenario where confidence in the dollar, the euro, the yen, all begins to crack simultaneously. Where would capital flow? It would flow to the only assets that have no counterparty risk. Assets that can't be printed, can't be debased, can't be defaulted on. Gold and silver. And here's something most people don't realize. The vast majority of gold and silver trading happens on paper markets, the COMEX, the futures exchanges, the ETFs. For every ounce of physical gold that actually exists, there are estimated to be 100 or more paper claims on that gold. It's fractional reserve banking applied to precious metals. This works fine as long as everyone's content to trade paper. But what happens when people start demanding physical delivery? We've already seen stress fractures. During certain periods of high demand, premiums on physical gold and silver have spiked well above the paper price. Dealers have run out of inventory. Mints have struggled to keep up with demand. These are warning signs that the paper market and the physical market are beginning to diverge. And when that divergence becomes a chasm, when the paper market is exposed as the fiction it is, the price of physical metal is going to do something that will shock people who aren't prepared. Now, I want to address something important here because I know some of you are thinking about your retirement accounts. You've got money in a 401k or an IRA, and you're wondering how this applies to you. Here's the reality. If you have $100,000 or more in retirement savings, and it's all sitting in traditional stocks and bonds denominated in dollars, you're taking on enormous currency risk that most financial advisors won't even discuss with you. But there's a solution that not enough people know about. You can actually hold physical gold and silver inside a retirement account through what's called a gold IRA. It's IRS approved, it's completely legal, and it allows you to get physical precious metals into a tax-advantaged account without triggering penalties or taxes. I put together a comprehensive guide on exactly how this works, the rules you need to know, the custodians that specialize in this, and how to do it properly. It's completely free, and you'll find the link in the description below. If you're sitting on significant retirement savings and this whole conversation is making you nervous about currency risk, it's worth checking out. All right, let's get back to the bigger picture because there's another dimension to this that we need to discuss. The geopolitical shift happening right now is unprecedented. For decades, the US dollar has been the world's reserve currency. This gave America an extraordinary privilege. We could print money and export our inflation to the rest of the world because everyone needed dollars to buy oil, to settle international trade, to hold as reserves. But that system is cracking. The BRICS nations, Brazil, Russia, India, China, South Africa, and now expanding to include others, are actively working to create alternative payment systems that bypass the dollar. They're settling trade in their own currencies. They're building new financial infrastructure. They're accumulating gold as the foundation for a potential new monetary system. Russia and China have been conducting bilateral trade in rubles and yuan for years now. Saudi Arabia, the linchpin of the petrodollar system, has been in discussions about accepting yuan for oil sales. The UAE is building gold trading hubs. Central banks across Asia and the Middle East are repatriating their gold from Western vaults. These aren't random events. This is a coordinated de-dollarization strategy. And here's why this matters to you, even if you never trade internationally, even if you never leave your home country. When the dollar loses its reserve currency status, when foreign central banks no longer need to hold massive dollar reserves, what do you think happens to all those dollars? They come flooding back home. And when trillions of dollars that have been sitting in foreign reserves suddenly enter the domestic economy, the inflation we've seen so far will look like a warm-up act. This is the nightmare scenario that keeps monetary historians awake at night. It's called the Reverse Plaza Accord, or the Great Dollar Dump, and while the timing is uncertain, the direction is clear. Now, let's talk about silver for a moment, because silver has a unique characteristic that makes it potentially even more explosive than gold. Silver is both a monetary metal and an industrial metal. It's used in solar panels, in electronics, in medical applications, in water purification. The industrial demand for silver is growing rapidly, particularly with the green energy transition. Solar panels alone are consuming hundreds of millions of ounces of silver annually, and that demand is accelerating. But here's the problem. Silver mining is largely a byproduct of other mining operations. Only about 30% of silver comes from primary silver mines. The rest comes as a byproduct of copper, lead, and zinc mining. This means silver supply is relatively inelastic. It doesn't respond quickly to price signals. So you have growing industrial demand, relatively fixed supply, and on top of that you have investment demand from people who understand the monetary crisis we've been discussing. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically around 15-to-1. Right now, it's trading closer to 80-to-1. That means silver is either dramatically undervalued relative to gold, or gold is dramatically overvalued relative to silver. Given everything we know about industrial demand, supply constraints, and the monetary situation, which scenario seems more likely? Many analysts believe silver has the potential to outperform gold in the coming years, possibly by a significant margin. And for people who can't afford to buy gold at current prices, silver offers an accessible entry point into hard assets. But whether you choose gold, silver, or a combination of both, the critical point is this. You need to own physical metal, not paper promises, not ETFs that might not have the metal they claim, not mining stocks that come with company-specific risks. Physical metal that you can hold, that you control, that has no counterparty risk. Let me tell you a story that illustrates why this matters. In 2011, MF Global, a major commodities brokerage, collapsed. Customers who thought they owned gold and silver in their accounts discovered that the company had used their metal as collateral for other trades. When the company went bankrupt, customers became unsecured creditors. They didn't get their metal back. They got pennies on the dollar in the bankruptcy proceedings. This wasn't an isolated incident. It's happened multiple times throughout history. When financial institutions get into trouble, customer assets that aren't properly segregated become part of the bankruptcy estate. This is why physical possession matters. This is why if you don't hold it, you don't own it, has become a mantra in the precious metals community. Now, I want to address the skeptics for a moment because I know some of you are thinking, this sounds like fear-mongering. The system has survived before. It'll survive again. And you're right that the system has survived previous crises. But each time it survives, it does so by adding more debt, more currency creation, more intervention. Each crisis requires a bigger response than the last, and we're reaching the point where the responses themselves are becoming the crisis. Look at what happened in 2008. The Fed dropped interest rates to zero and launched quantitative easing. That was unprecedented. It was supposed to be temporary. But here we are, over 15 years later, and we still can't normalize monetary policy without threatening to collapse the entire system. In 2020, when the pandemic hit, the response was even more extreme. Trillions in stimulus, direct payments to citizens, the Fed buying corporate bonds, something they'd never done before. The balance sheet exploded to nearly $9 trillion. And now, every time they try to reduce that balance sheet, every time they try to raise rates to combat inflation, something breaks. Banks fail, markets convulse, and they're forced to reverse course. This is the definition of a trapped system. We can't go back to normal because normal would expose the insolvency that's been papered over with printed money. So what's the endgame? There are really only two possibilities. Either we go through a deflationary collapse where debt defaults cascade through the system, asset prices crash, and we experience a depression that makes the 1930s look mild. Or we go through an inflationary crisis where central banks print whatever it takes to prevent that deflation, and the currency itself loses credibility. Historically, governments always choose inflation over deflation. Always. Because inflation allows them to pay back debt with devalued currency. It's a hidden tax that most people don't understand, and it's politically easier than the alternative. But here's what makes this time different. We're not just talking about one country inflating its currency. We're talking about a coordinated global monetary experiment where every major central bank is doing the same thing simultaneously. There's no safe haven currency. There's no place to hide in traditional fiat, except there is. Gold and silver have been safe havens for 5,000 years. They've outlasted every empire, every currency, every monetary system that's ever existed. The Roman Empire debased its currency and collapsed. The Byzantine Empire did the same. The Spanish Empire, despite importing massive amounts of gold and silver from the New World, inflated its currency and declined. The British Empire, the French Empire, every major power that's ever existed has eventually debased its currency and faced the consequences. And America, despite our technological advancement, despite our military power, despite our economic might, is not exempt from the laws of economics and mathematics. The debt cannot be repaid. The promises cannot be kept. The system cannot continue on its current trajectory. And when the reset comes, when the current monetary system gives way to whatever comes next, the people who position themselves in hard assets beforehand will be the ones who preserve their wealth. Let me give you another historical example that's particularly relevant. In 1971, when Nixon closed the gold window, most Americans didn't understand what had happened. They didn't realize that the dollar had just become a pure fiat currency backed by nothing but faith in the government. Life went on as normal for a while, but over the next decade, that decision unleashed inflation that peaked at over 14%. Interest rates hit 20%. The stock market went nowhere for a decade when adjusted for inflation. Real estate, when adjusted for inflation, barely kept pace. But gold went from $35 to $850. Silver went from $1.50 to $50. People who understood what was happening and positioned themselves accordingly multiplied their wealth many times over. And here's the thing. We're in a similar moment right now, except the distortions are far greater. The debt levels are far higher. The money printing has been far more extreme, and the global monetary system is far more fragile. The people who understand this, who study monetary history, who pay attention to what central banks are doing rather than what they're saying, are accumulating gold and silver as fast as they can. And it's not just individuals. As I mentioned earlier, central banks are doing the same thing. Sovereign wealth funds are doing the same thing. Family offices that manage the wealth of the ultra-rich are doing the same thing. They're not doing this because they're pessimists or doomsayers. They're doing this because they understand probability and risk management. They understand that the current system has a mathematical endpoint, and they want to be positioned correctly when we reach it. Now, let's talk about timing, because I know that's what everyone wants to know. When is this going to happen? When should I buy? The honest answer is that nobody knows the exact timing. Markets can remain irrational longer than you can remain solvent, as the saying goes. The system could limp along for another year, another 5 years, maybe even another decade. But here's what we do know. The trend is clear. The direction is set. And the longer the system continues, the more extreme the eventual correction will be. Think of it like a dam with cracks forming. You don't know exactly when it's going to break, but you know that every day that passes, every additional strain on the structure increases the probability of catastrophic failure. And if you're living downstream from that dam, you don't wait until you hear it cracking to move to higher ground. Gold and silver are higher ground in the monetary system. And here's something else to consider. Even if the catastrophic scenario doesn't play out, even if somehow the system muddles through, gold and silver still serve as insurance against currency debasement. They still preserve purchasing power over time. They still provide diversification from financial assets. In other words, the downside of being wrong is minimal. You own assets that have held value for thousands of years. The downside of being right and not being positioned is catastrophic. You watch your life savings evaporate in real terms as currency debasement accelerates. This is asymmetric risk. The potential downside of not owning hard assets far exceeds the potential downside of owning them. Let me address one more objection I often hear. People say, but if the system really collapses, if things get that bad, won't the government just confiscate gold like they did in 1933? It's a fair question. Roosevelt did issue Executive Order 6102 requiring Americans to turn in their gold, but there are several important points to understand about that situation. First, it happened when the dollar was still officially backed by gold. The government needed gold to maintain the monetary system. Today, with pure fiat currency, there's no technical need for the government to confiscate gold. Second, compliance was actually quite low. Many people simply didn't turn in their gold, and enforcement was minimal. Third, even if confiscation were attempted today, it would be far more difficult to implement. In 1933, most gold was held in large bars in bank vaults. Today, gold ownership is far more distributed, often held privately in small denominations. Fourth, and most importantly, even in the worst-case scenario where gold was confiscated, the government would have to compensate owners at some price. And that price would likely be far higher than today's price, because confiscation would only happen if gold had already appreciated significantly. So even in the worst-case scenario, you'd be better off having owned gold than not. But I don't think confiscation is the likely scenario. I think what's more likely is that governments will try to control gold through taxation, through reporting requirements, through making it difficult to use in transactions. They'll try to keep people trapped in the fiat system as long as possible, which is exactly why you want to position yourself now, while it's still easy to do so, while premiums are reasonable, while availability is good. Because when the crisis becomes obvious to everyone, when the mainstream media is finally reporting what's been obvious to those paying attention, it'll be too late. Premiums will spike. Availability will dry up. You'll be competing with millions of other people who suddenly understand what's happening. The time to buy insurance is before the fire, not after. And make no mistake, what we're talking about here is insurance. It's wealth preservation. It's protecting what you've worked your entire life to build from a monetary system that's designed to devalue your savings. Think about your situation right now. If you have money in a savings account, you're earning maybe 4 or 5% interest if you're lucky. But real inflation is running higher than that. You're losing purchasing power every single day. Your savings are being quietly confiscated through currency debasement. If you have money in bonds, you're locked into a fixed return in a currency that's being systematically devalued. You might get your principal back, but what will it buy? If you have money in stocks, you're exposed to market risk, company risk, and currency risk all at the same time. And valuations are at historic extremes by almost every measure. Real estate has been a traditional inflation hedge, but property taxes, maintenance costs, and illiquidity make it imperfect. And in many markets, prices have already run up to levels that assume continued currency debasement. Gold and silver offer something unique. They're liquid, they're portable. They have no counterparty risk, they can't be debased, they've maintained purchasing power across millennia, and they're still, relative to the money supply, relatively undervalued. This is not about getting rich quick. This is not about speculation. This is about survival. This is about making sure that when the monetary reset happens, when the current system gives way to whatever comes next, you're positioned on the right side of history. The wealthy understand this. The central banks understand this. The question is, do you understand this? Because we're running out of time. The cracks in the system are becoming more obvious by the day. The debt spiral is accelerating. The geopolitical tensions are rising. The de-dollarization is progressing. And the window to position yourself is closing. I'm not telling you to panic. I'm not telling you to sell everything and buy gold tomorrow. But I am telling you to take this seriously, to do your own research, to understand the monetary history, to look at what's happening with clear eyes rather than through the lens of normalcy bias. Because the death of fiat currency isn't some theoretical possibility, it's a mathematical certainty. The only question is timing and whether you'll be prepared when it happens. Get hard assets, get physical gold and silver, get them into your possession or into a secure allocated storage arrangement where you maintain ownership. Do it now while it's still easy, while premiums are reasonable, while the system still functions normally. Because the time is coming when normal will be a distant memory, and the people who prepared will be very glad they did.